Hey everybody, this is Justin Munt. I'm an insurance agent and financial advisor with Munt Associates. I also own Munt Consulting, a consulting firm that helps CPAs offer more proactive and holistic services to their best clients. Today I have a specialist with us. His name's Chris Ostler. He's a CPA and managing partner of Veracity LLC, a tax advisory services firm. Chris specializes in cost segregation, and I'm going to have Chris explain a little bit about cost segregation. Chris, thanks for being here today. Tell us a little bit about yourself, your background, and what you do for our clients.
My pleasure. My background is in accounting, graduated with a degree in accounting, and out of school went directly to work for one of the big national firms, Deloitte. Spent a number of years there, and that was back in the early to mid 90s. So I've been a CPA for 25 years this April. And the entire time I've been a CPA, I've had my ear to the ground with taxes and provided other tax advisory services in the past as well. I've been focused on cost segregation now for roughly 10 years. And the past 10 years, there's been a number of really important and exciting changes in the cost segregation world that hopefully we can talk about a little bit today.
Great. Well, let's talk a little bit about cost segregation. Some of our viewers own commercial buildings. Tell us a little bit about how it works and give us an idea of the ins and outs of what a cost segregation study really is.
Sure. Cost segregation study is really a straightforward way to accelerate depreciation on any commercial or residential real estate. The reason we want to try and accelerate depreciation is because the determined asset lives for these types of assets for tax purposes are very long. For example, a commercial building, the IRS requires that we depreciate that building over 39 years on a straight line basis. And for residential rental properties, we have to depreciate those over 27 and a half years. Now, I don't know about you, but 39 years from now, I probably won't be too worried about depreciation or cost segregation for that matter. So many taxpayers feel the same way, and they want to take advantage of accelerated depreciation. So cost segregation is really the art and the skill behind finding those assets within a building that can be depreciated on a quicker basis. And so that's what we do. We use our expertise in the tax code and our expertise in the engineering process to find those assets, identify those assets, and categorize them in such a way that they can be accelerated for the taxpayer's benefit.
And what is the ideal client? I mean, explain a little bit about who the ideal client might be in a situation where we really had a home run doing a cost segregation study for a building owner.
Sure. Ideal client is really anyone who owns commercial or residential rental property. And the reason I say anyone is, I know that sounds really broad, but the Tax Cuts and Jobs Act really changed the landscape when it comes to cost segregation. So in late 2017, the laws changed that allowed commercial and residential rental building owners to depreciate not only new purchased assets, but all used personal property assets could be subject to bonus depreciation. And the big change to the law over and above that was that bonus depreciation percentages went from 50% to 100%. So I guess to narrow it down, if you've got a client who has purchased a commercial or a residential rental property and placed it in service after 27th of 2017, any personal property that we find through the cost segregation process is going to be essentially 100% expensed for that taxpayer. And that is a massive change from prior years. Now, there are other ways to get benefits from cost segregation if you had buildings placed in service in years before 2017. Again, we just need to see the details so we can evaluate exactly what kinds of benefit would be available to the taxpayer. But as far as a home run, almost every single job we've done since that Tax Cuts and Jobs Act change has been a home run for the taxpayer. On average, we're finding that 30 to 40% of the depreciable cost of a building we've been able to move that into personal property and expense it. Just to put that in perspective, say you bought $1 million commercial building, and normally that building would depreciate 1/39 of that cost over 39 years. You would get just a tiny fraction of that cost in the first year as depreciation expense. The first year of depreciation expense now on that same $1 million building could be $250,000, $300,000, $350,000. It's just a substantial tax deduction in the first year based on existing rules. So every client who's purchased since 2017 September is really the ideal client.
Yeah. We've noticed that too. And working with you, the clients that we bring this idea to has made a substantial difference on their income taxes right now. So talk a little bit about your process, the steps of completion, what's involved, and how easy is it for the client to get something like this done if they feel like they have a property that they'd like to have a cost segregation study done on.
Yeah, that's actually a great question. It really starts with some very basic information. I really only need 3 pieces of information to do a free, no-cost analysis of what we think we can do with the property. We need the physical address, the complete address of the property. We need the date that asset's placed in service. And I need to know what the tax basis of that asset is. That's the simplistic way of putting it. There's a couple different ways that we'll get that information. If it's a new purchase, say somebody bought a building in 2020 and they haven't filed their taxes yet. Well, since that asset hasn't been put on a tax return yet, what we'll need really is that closing escrow statement. That escrow statement is going to give us the address of the property, the date that it was purchased, that would be the presumed in-service date, and what the total purchase price was. Now, there's a little bit of work to be done still because we have to figure out how much of that purchase price is going to be allocated to the land that the building sits on versus how much is going to the building, which is then going to be the depreciable amount. So now for buildings not purchased in 2020, buildings already on a tax return, it's really simple. We go to the tax return itself, and the tax return will have a schedule that will allow us to see those assets, and we'll see the in-service date and the depreciable amount, and we can use that as the foundation. So once we have that information, we will provide a 5-page benefit analysis that is really a presentation piece to show the taxpayer how much depreciation expense we believe will be able to deliver that year. And that number, depending on the basis of the property, how many properties we're evaluating, how long ago the property is placed in service, there's a number of factors that will figure into what that number turns out to be. So once we have that free benefit analysis, we send it to our client via consultants like yourself, and then it's presented to the client. If they want to go forward, we draw up a simple contract. It's 3 pages long, expressing exactly what we're going to deliver and what our deliverable is going to be. By the way, our deliverable conforms completely with the IRS's standard that they use as a quality cost segregation study. So it'll be a fully engineered study, fully compliant with the IRS's idea of a quality study. And once we get that engagement letter signed, we will schedule a site visit. We'll need to come to the property, walk through the property, take some notes, take some pictures, and document what we see. Once that happens, 30 business days later and no longer, we will generate an engineering-based report for that taxpayer and deliver it.
Great. And you've stood by that. I mean, working with you has been super smooth. Clients have enjoyed working with you. My CPAs that I work with are very happy. So thank you so much for what you've been doing for us so far. And to the commercial building owners out there and CPAs that are listening that have clients like this, guys, Chris is a super resource for us. He does a great job. Chris, thanks so much for being a part of this call today, and we look forward to keeping things going with you in the future.
Very good. Thank you so much.